do with you? When you got there? Oh, I'm fine.
I didn't want to miss it.
You didn't miss nothing while you were down there. Okay. So. When you think of accounting, what comes to mind?
Numbers. Money.
Numbers, money. What else? Money, numbers, banking, business. That's it?
T-chart.
T-chart? T-account?
Checks and balances.
Checks and balances. Okay. All of those things do relate to accounting. And so what we're going to talk about today is just the importance of it. What's the foundation? How was it formed? How did it start? Right? So the importance of accounting. You do three things in accounting. You identify, you record, and you communicate or analyze. Okay? So identifying means if you sell me something, that's an event, right? And I have to record that event. So I have to record what about it?
The
amount, the date,
The amount, the date, not necessarily the time, but the amount, the date, and what was involved, right? What was exchanged for what? And then I have to communicate that to who?
Yeah, banker.
Maybe. Maybe. This is where users of accounting comes in. So there are people on the outside and on the inside that will find accounting information useful, right? You got external users. Those are the people who probably lend you money, who have invested in your company, right? The people who actually patronize your business and your product. And so you have to report your transactions and your financial position to those who are external and need that info. And then you have the internal people. So those are the managers, the auditors, the accountants, the staff, whether it be administrative, sales, whoever it may be. Those people need that information to do what with? What do you think the internal people need financial information for?
So to know how to know what's going on with the company.
Right, you need to make decisions. It's all about making important financial decisions. So here are the decisions that must be made. Everybody in here works for some type of company, right? Or has at some point. So there are times where you have to make decisions about who works on what day, right? So payroll, who to hire, who to fire, how much they need to do in sales, how much they need to cut back on as far as expenses. All of those are a part of decision making. So this is why the info is important, just as important to internal users as it is for external users. Let's see. So opportunities in accounting for you accountants. These are some of the many areas you could go into once you graduate and get your credentials. And all of them are beasts within their own little right. And it depends on, what you want to do. And hopefully, before it's all said and done, we can convert some of you other business majors to respect accounting and maybe potentially want to transition over, right? No. So let's see if you said no. No, okay. Well, I tried. We'll see. Let's see if you can identify who's an external user compared to internal. So regulator. I heard one internal, one external.
External.
Majority external. CEO.
Internal.
Shareholder.
Internal.
Controller.
Internal.
Executive employee.
Internal.
External auditor.
External.
Production manager,
Intern.
non-executive employee.
Intern.
Let's see if you were right. Were you?
Yeah.
You didn't even look at it. You just say, yeah, we were right. Okay. So let's read this in red. External users of accounting information are what? Not directly involved in running the organization. They may have contributed to the start of the organization and the operating of it, but they were not directly involved in it. Internal users are the ones who are directly involved and actively managing and operating. So ethics. Yes. What do managers do? No, regulator would be those big important people, you know, like the IRS,
Like OSHA or something.
Yeah.
OSHA,
Managed ethics.
Department of Revenue. Those are the people that can tax you, shut you down, temporarily or permanently, depending on what's going on. Yes, ma'am.
Isn't management just provide this certain part that he manages or she manages in that particular.
That just depends on the business. The manager is just a manager. Those are people that supervise in some kind of capacity. Ethics. So why do we need to have a discussion about ethics, specifically in this course? You are dealing with some vital and very sensitive information, right? On all different aspects. So it is very important that you know what ethics means, you know what integrity means, right? So I'm gonna give you a scenario. What's your name? Tommy. Tommy. Okay, so Tommy works at ABC Corp. What's your name? Burnett. And Burnett also works at ABC Corp. And Michelle is the CEO at ABC Corp. Michelle calls the shots, right? Tommy is an employee who has not been paid his commission. And Burnett is the one that writes the check. Burnett wrote a check to Tommy for $5,000. And Burnett knows that any check that's over $500, Michelle has to sign as being the CEO. But Burnett and Tommy are cousins. And so Tommy says, Burnett, just sign the check. She won't mind. What was the ethical conflict in that?
Cousins.
Cousins, which creates the conflict of interest. What else? You decided to sign a check for your cousin, and it was over $500. It was $5,000. And so you didn't follow protocol, right? So let's talk about the implications of doing that. 1, job loss for both of you, right? 2, fraud. 3, jail. 4, restitution, because whatever you stole, you must pay back. And so we identified what the issues were. We analyzed the consequences of it, because there's nothing good that could come out of that. And the best option is for you to do what? Which is? I'm sorry, Tommy, you just won't get paid today. Until Michelle signs the check, right? So this is typically how fraud starts. When we're looking at the fraud triangle, an opportunity is presented. Going back to the scenario I just said, what was the opportunity there?
Money when he wants
money. $5,000 money, right? And that may not even be what he was owed. Then rationalizing it, Tommy said, Burnett, it's okay. She won't mind. Not considering Burnett could lose his job and be thrown in jail for helping a cousin out and just signing a check, right? And so then you have financial pressure to commit fraud, right? So this is typically how it happens, and it goes in that circle and it keeps going in that circle until you do the right thing, which is act in a ethical manner, right? So let's talk about generally accepted accounting principles, or what we like to call GAAP. That's the acronym. GAAP is a set of principles that corporations in the United States are governed by. So the reason why we use GAAP is because we know whatever information is published up under the GAAP principles is reliable, is somewhat accurate. We know that it can affect the decisions of both internal and external users, and it's also helpful in the industry to compare against other companies that's within the same, maybe competitors. So we also have IFRS, and that's International Financial Reporting Standards. That's used for the companies that are outside of the United States. They have the opportunity to use GAAP if they do business in the United States. So you know how all of these companies do like imports, exports, those types of things. They operate in the United States as well. They might choose to use GAAP, but for the most part, they are governed under IFRS. Now, GAAP was developed by FASB, the Financial Accounting Standards Board. IFRS was developed by IASB, which is International Accounting Standards Board. So some companies are converging, that's where you see this word here, from GAAP to IFRS, because IFRS is a simple set of standards, okay? They like to say that GAAP, those principles are rule-based, meaning you got to either follow the rule or don't do it at all, right? Whereas IFRS, there's some leniency. Like when we talk about inventory, granted, under GAAP, you have a choice. You could use FIFO, you could use LIFO, you could use any other method. However, whatever you use, it must be consistent. So if in 2009, I used FIFO, and in 2010 decided I want to go to LIFO, I got to do LIFO for 2010, 2011, and 2012. I can't go back and forth. I can't straddle the fence. Whereas under IFRS, you can only do FIFO. There's no LIFO under that. And that's probably a good thing for some companies, because what that's saying, you hear me saying FIFO and LIFO. FIFO means first in, first out. Meaning what you buy first is what you sell first. LIFO is last in, first out. So it would make sense. IFRS is saying, okay, all you international companies that like to import, export items, we're going to make sure that you only use FIFO, because we want to make sure that you get that old inventory off your hands and right away, so that you don't lose valuable money, right? That has some pros and cons to it, but I just want you to know the difference between the two. Okay, convergence, that's just talking about the things that would be factors in deciding whether or not it's worth converging. Because companies can't just up and say, we're going to switch to IFRS. And why do I say they can't do that? Who thinks they know? If you're a publicly traded company, that means you have what? Shareholders. And can you do anything without consulting them?
No.
No. So if I'm a company and I am operating under GAAP and I want to switch to IFRS, I cannot just do that on my own merit. I have to have someone vote on it in order for me to do it. And when they vote on it, these are the things that they're looking for. Is it going to be useful information still to us if you adopt IFRS? Is it going to be relevant, reliable, and can I compare it to your competitors? What financial statements are going to be in place in order for me to verify that? And also, how do you recognize things differently on your financial statements, such as inventory? What are those elements, and how is that going to change under the new system? Okay, so we have some different principles under GAAP that you need to be concerned with. These are the list. This diagram is also in your textbook, but here they are broken down. Cost principle, or the measurement principle, that means when we record something, we record it at cost, not what we estimated it to be, not what somebody else estimated it to be. So if I went out right now and bought a piece of equipment for $5,000, what do I record? $5,000. That's all that means. Revenue recognition principle, revenue, profit, sales, whatever you call it. When you earn it is when you recognize it. Regardless of whether you receive cash for it. Right then. When you earn it, that's when you put it on the books. Expense recognition, same situation. When the expense happens is when you record it, not when you actually pay for it. So for instance, if you know that you have a wage expense because people worked for you this week, but you don't pay them until next Friday, you record that expense when?
Next Friday.
No,
Right.
right when they work. So let's just say normally a pay period is what, every 2 weeks or so?
Right.
So people have worked for 2 weeks, but they don't get paid until maybe that Friday on that second week, right? Or the week after, however it works. Expense recognition just means this. Michelle worked Monday through Friday. I gotta recognize that her wages are an expense for me, even though I won't actually pay it to her
Okay.
until the following Friday.
But I have to write that down.
Right,
Like the hour.
Monday, Tuesday, Friday.
what they earn. Full disclosure, all that means is this. If you invest in a company, they're a publicly traded company, they're on the stock exchange, all that means is that anytime you look at their annual report and their financial statements, there should be a full disclosure section, meaning we are disclosing everything and anything that is related to you making decisions about staying as an investor with our company, or shareholder with our company. So for instance, you know how I was talking about the FIFO LIFO thing? Let's just say we do decide to switch to LIFO, and we have been doing FIFO for maybe about 5 years, and then switch to LIFO. Don't you think the person is reading your financial statements as a shareholder would need to know that? Because the amounts of inventory values and what you've capitalized and expensed might be considerably different from year to year if you've switched methods. So those are the things that they need to know. If you did a different method of depreciation for your equipment and all of your items, assets, they would need to know that. So those things need to be disclosed in the notes somewhere within the annual report. And for your project for this class at the end of the semester, you'll be able to look at an annual report and you'll see the areas of disclosure. Here are some other ones. Going concern reflects assumption that a business will continue to operating instead of being closed or sold. So going concern is simply this. I start a corporation, even when I die, what happens to that corporation? It continues to operate. It doesn't stop. They just pick another CEO and they keep moving, right? Because who ultimately runs the company? Shareholders and the board of directors. So whether you started it with your money, it doesn't matter. When you die, it continues to move forward. Okay? So we have to continue to operate in business with the assumption that it's going to continue to operate. Business entity assumption. Business is accounted for separately from other business entities, including its owners. That just deals with, we have sole proprietorships, we have corporations, we have partnerships, but everything is operated outside of the individual. So for partnerships, even though they're in business together, they are separate from their entity, okay? Even as a sole proprietor, yes, you may own the business, but your business dealings and transactions is completely separate from the business. Monetary unit consumption. That just means all transactions, we're going to express them in monetary units, meaning in dollars. Okay? Time period assumption, an accounting period is broken down into months. So 12-month period could be an accounting period. It doesn't matter if the 12 months started in February and ended 12 months from there. That 12 months will be considered an accounting period. Okay? So this is what I was talking about with the business entity principle, right? Sole proprietorship, partnership, and corporation. With a proprietorship, only one owner is in effect, right? Is the business taxed? No, because it's a sole proprietor. Limited liability? No, because when you're a sole proprietor, the liability falls completely on you. Well, yeah, we hadn't quite got to that, but ultimately, if you're a liability, it all falls on you. Business entity, yes, it's considered an entity. It's just owned by one person. Legal entity, no, because when you're taxed personally for your business items as a sole proprietor. Unlimited life, no, because if the person dies, what happens?
And keep going.
It's over. It's a proprietorship. It's over. Partnership, one owner allowed? No. A partnership is defined by 2 or more people. If it is in the business tax, no. If it's 2 partners, guess what? They pay taxes on their income shares from that business separately. Limited liability, no, because each partner takes on a percentage of liability. All of that is written out in a contract from the beginning. Is it a business entity? Yes. Legal? Absolutely not. It's kind of similar to proprietorship. And it doesn't have unlimited life because in a partnership, if one partner dies, what happens?
It goes to the other person.
It's done. That's what people don't know about partnerships. When you enter into a partnership and an agreement, if one partner dies or leaves or whatever, the business is shut down. It does not continue to go forward. Now, the only exception to that, there is an exception. If before that person departs, you automatically get somebody else to buy into the partnership and do a whole new agreement, your business can continue to go. But if you don't bring somebody else in and that person just leaves, you have to disband everything. Okay? Corporation is yes for everything because yes, you can have more than one owner of a corporation. Yes, it's taxed on 2 levels, both personal and corporate. Corporate tax, double tax. It is a limit liability because the corporation is liable, not the individual who owns the corporation. Business entity, yes. Legal entity, yes. Unlimited life, yes. Because if any of those owners of the corporation die, the corporation will continue to operate. Okay? SOX. Now, this is very important. How many of you know what Sarbanes-Oxley is? Nobody. Okay. So SOX was put in place back in 2002. The reason for that, I'm sure everybody heard of all these big scandals, right? Enron, Tyco, all of those, right? So what happened was that FASB and the SEC came together and said, we need some type of regulation that is going to keep these businesses from abusing their right to share stock and sell stock and buy stock. They don't have the option to hide any more information from the general public about their financials, okay? Because the moment that they do that, we can regulate them, we can shut them down, we can make people accountable, we can lock people up, we can do all those things, get restitution, so forth. So here are some of the scandals. When you have a chance, you can read up on them. But these are some of the things that were being abused financially that created SOX to begin with. So inflated income, they hid their debt. And normally when a company hides what kind of debt they have, they do that so that they can get more loans from the bank to fund these investments and everything that they have. Okay? And that's fraud, because if the bank lends you money based on you saying you had little to no debt, eventually they won't get their money back because you can't even pay the debt that you already had because you felt the need to hide it. Does that make sense? Okay, so most of these are inflated income. Bristol Myers was inflated revenues and income. Basically, they, completely went overboard with revenue. So they're all pretty much the same. But this is what SOX protects the public from. Having to have a big downfall that happened, like with Enron and Tyco. These people have invested and have become shareholders of these companies, and these companies financially are not in a good position. And so therefore, when they were getting ready to shut down because the executives had high incentives and they had all of this expensive art and they had, they were getting all these bonuses and everything, but yet the shareholders were not getting dividends. Now, if you're in a corporation, a CEO or CFO or whatever of a corporation, and you have all these high bonuses that you're getting, me as a shareholder, I expect to be getting some good dividends. Because if you can do well based off of the company's profit, I should be able to do well off of the company's profit. And that's what got a lot of these companies just in deep trouble, because they had executives who were greedy. And they were taking money and they were putting stuff in offshore accounts and doing a lot of stuff that they shouldn't have been doing. Okay. So read up on that when you have a chance. Also read up on Dodd-Frank, Wall Street reform, because that's also protecting the consumer. Everybody remember the bailouts with the mortgages and everything? That's what this relates to. They have to put some type of act or law in place to cover people like the consumer when banks do underhanded things and schemes to get the consumer's money. Because a lot of people lost their homes, a lot of people had to file bankruptcy, a lot of people lost a lot of equity in their homes. Even if they were able to keep them, the equity was gone. They couldn't sell their homes, so it was just a lot of implications. And the Dodd-Frank Wall Street reform protects consumers against those types of things like bailouts and so forth. All right, so let's see. This is just talking about the principles again. We went over those, and we don't have to do that again. The accounting equation. Now, this is the important stuff. The other stuff was important too. These are the things I need you to write down. So this is the accounting equation. I need you to know it like the back of your hand. Assets equals liabilities plus owner's equity. And you can actually come up here to a desk in the back. So assets equal liabilities plus owner's equity. First of all, let's define what an asset is. What is an asset? What do you think it is?
The stuff you own.
Things you own. What do you own right now? Cars, homes, right? So assets are resources that are owned by a business. It could be anything from supplies to equipment to land to a building, right? Prepaid things like, you know how people may prepay insurance up 6 months? That's even an asset, because until the month passes, the business owns that insurance, right? And then liabilities. What are liabilities?
Your bank account.
It's I don't want to use the word debt because we have other things that are considered to be actual debt, but yeah, it's basically claims. Okay, claims to assets by external parties. So, for instance, liabilities are short term, meaning they have to be paid within 12 months, no more. Okay?
Something like these.
Bills, insurance, different.
No, not insurance. That's why I didn't want to call it debt.
Oh.
Perfect example. You know how you go to somewhere like Macy's or Walmart and you get a store credit?
Yeah, like credit card.
That's basically what accounts payable is.
Okay.
So, accounts payable is a liability, by the way. But that's basically what it is. All it's saying is, I'm going to get what I need from you today, and I'm going to pay you in 30 days, 30 to 45 days.
A little bit.
Yeah, sort of layaway. I guess you could say it like that. But I don't know. Yeah, the best thing I can use is credit card, though.
Yeah.
Claims against the assets by external.
External users. And the official definition that your book gives you is on page 14. So liabilities are creditors' claims on assets. So when I say accounts payable, typically that means you owe someone, whether it be for supplies or whatever you got from them. You put it on credit and you owe them. Now, if I say accounts receivable, which is an asset, that means what? Accounts payable means you owe someone.
Somebody else.
Customers owe you. So that means they weren't able to pay you cash for whatever you sold them.
So
Or-
it's like an IOU.
No, not an IOU, because IOUs don't always get paid. But it is like, you know, the customer does owe you for product or service that you perform. And it's to be received, which is why it's called accounts receivable. And-
Maybe like if I'm a hairdresser and then I'm doing your hair, then I receive money,
No,
not like that.
because I don't know no hairdresser that's gonna give you 30 days to pay them.
Oh, okay, 30 days, okay.
Accounts receivable would be more so, I am a vendor and people come and purchase my product. But I have some customers that I trust and I know they will pay me in 30 days because it's gonna take them 30 days to probably sell the item and get my money to me. So I tell them I'm gonna put you on a receivable, meaning I expect to receive my money for the product that you got today within 30 days. Does that make sense? If you perform a service or you sell an item and you get cash, that's just what it is. It's just cash and revenue. But if you sell an item and they weren't able to give you cash right then, but you gave them your product, that is an accounts receivable because you're expecting to receive your money in the future.
So like renting a home.
Yeah, renting would be an example of that, yes, because you don't pay your rent. You pay your rent at the beginning of the month, right? For that
So you expect that.
current month. So your landlord is expecting on the first of every month to get rent from you. Okay. That's a good example. Car note. That's a good receivable on their end. They're giving you 30 days to make your car payment, you know, to them. They're expecting that from you, but you got the car
So
today.
would that also be considered a liability?
It is. It's a note. Yeah. It's a liability. Look at the perspective. If you are the person purchasing the car, it's a liability to you.
They
And
still
who
have
you're
to
purchasing it from? It's a receivable for them. Does everybody understand?
Yeah.
So the car company, let's just say CarMax, you go and you get the car. At that point, you've created a liability or a note for yourself, right? And then CarMax is going to recognize it on their books as a receivable because they know that they're going to receive a car payment from you every 30 days. Everybody's clear about that, right? All right, equity. Now this can go a couple of ways. Equity, we got capital. Let me tell you what capital is. Capital is an owner's investment into the company. So for instance, if I started a company and I invested $10,000 of my money, how much is in my capital account? $10,000. Owner's withdrawals, the same situation. I went and I withdrew $600 from the company. So that's a withdrawal. Revenues, that's whatever you earn, whether it be through service or selling a product, we always recognize revenue. And expenses, I don't want you to confuse expenses with liabilities because it is totally different. Expenses would be incurred right now, even though they're paid later. So for instance, don't you have a utility bill every month? That's an expense. Regardless of when you pay it, you know that it exists. Everybody understands, right? Telephone bill, you have that every month, right? What's the difference? What can you see between that and a liability?
You own it for a company, for 30 days.
Think about it. With a telephone bill, do you know how much your telephone bill is gonna be?
Yeah.
No.
Well, it depends on
I do.
Forget Metro and forget all of that.
You don't know.
You don't know.
Keep up, I know.
No, you don't know. Because they can come tomorrow and say, here's an extra tax.
Yeah, they
Oh,
can.
yeah, they do that.
So you don't know. Your utility bill, do you know what that's gonna be for sure every month?
No.
No. But you know that it's an expense that you have, correct?
Yeah.
So that's what makes it an expense. Is the fact that you may not know the amount, you just know it exists. So what's important here is what I need you to know. Net income. Net income only comes from subtracting expenses from revenue. That's what you need to write down. Revenue minus expenses equals net income or net loss. Net income comes from revenues minus expenses. So it could be a net income or net loss. Obviously, it's not good to have a net loss, right? Meaning a negative number.
Take a check. That's hard question. So the expenses be like supplies for your company.
No, supplies is what? What do we say supplies was?
Liability.
Asset. Supplies is the asset. Now, supplies will become an expense as it's being used. Let's just say at the beginning of the year, you started off with $500 worth of supplies. And by the end of the year, you only had $250. What part of that is the actual supplies expense? The $250 that was used. We understand, right? So supplies is an asset, but once it's used, the portion that is used is the expense. Because that must be replenished. Okay? Let's try this out since now you know the equation. What's the equation again? Assets equal liabilities plus owner's equity or plus equity. They want you to find the missing amount. So if assets equal liabilities here for Bowles, we got $150 assets and then liabilities of $30. That must mean equity is what? 120. For Vogue, we're missing assets, but we have liabilities and equity. What's the assets? 400. That's pretty simple, right?
Yeah.
Come down here, which is what we're going to do on these sheets right now.
Right?
No, don't write it down, but I just want you to see this is what we're doing. So from up here, right, we had assets of 150. Oh, no, they want us to find the missing here, too. So I told you revenue minus expenses equals net income, right? So how do we find our revenues here? How about here? You got revenues and expenses. Do we know what withdrawals are? No? Why do we say 60? Because of the owner's capital? That's $10. Where are we getting these amounts from? Just look at it for a minute.
On the capital. Let's do minuses.
220 minus 120 gives you what? 100. Minus 90 and minus 10. Ultimately, you're trying to get back here. 100 plus 0 minus 60. We'll work on it more. Now, these transactions, they're giving you the accounts to list them under, okay? We got to figure out how to journalize or how to make sense of these transactions. And I just want you to look at it because you're gonna do this. But January 1st, they invested $4,000 cash. So where did the $4,000 go? Cash increased. Those are the kind of words I want you to use. So cash increased by $4,000, and what else increased? Capital, because I told you anytime an owner invests in a company, that is considered what? Capital. January 5th, the company purchased $2,000 of equipment on credit. So where did the $2,000 go? What increased? What account? Equipment, because you did purchase equipment. And what else? Accounts payable to be paid sometime in the future, right? January 14th, provided $540 of services for a client on credit. So what increased? Accounts receivable, because the customer is gonna pay you later, right? And what else increased? You earned revenues. January 21st, the company paid $250 cash for an employee's salary. So what decreased? Cash. Cash decreased. But what increased? Expenses for $250. So we took these totals here, right? Because you need to add all these up. $3,750 plus $540 plus $2,000 equals $6,290. Total liabilities, $2,000. Assets equal liabilities plus owner's equity. So in order for us to get this $6,290, these had to equal $4,290. Everybody sees? Yes? Financial statements. These are the most important, so write that down. Most important top four financial statements. Income statement, statement of owner's equity, balance sheet, and statement of cash flows. Now, what do all of them do? Income statement. This shows that net income or net loss. So the only thing, and that's what I want you to write down, the only thing that is on an income statement is revenues and expenses. Everybody's clear? The only thing that is on an income statement is revenues and expenses. Statement of owner's equity. That shows the changes in equity for a company and for their owners. So it shows their withdrawals, it shows their capital, and it also shows the net income that comes from what statement? The income statement. This is why it's so important that these statements are completed in this very order. Okay? Balance sheet. The balance sheet really shows a company's financial position. It only has on it assets, liabilities, and what else? Equity. Because ultimately, you're trying to still calculate the equation through that statement. So the balance sheet only has assets, liabilities, and owner's equity. What does the income statement have? Revenues and expenses. Statement of owner's equity has? Yes. And then balance sheet has? And then the statement of cash flows identifies both cash inflows and outflows over that period of time. So everything dealing with cash only is on that statement. Nothing accounts payable, nothing accounts receivable, only cash is on the cash flow statement. Because what we're trying to do is look at our beginning cash balance and verify our ending cash balance. Everybody's clear? Okay. We won't do that because we're about to do this example. And that is it for that part. Now, what I want you to do is pull out those papers I've given you. There's more up here. Now, this one sheet that I've given you explains debits and credits. And as you go forward, I would suggest you keep this until you have it down pat, okay? Because you must know when we do T accounts what side transactions fall on, okay? So just keep that. But the other sheet that I gave you, which was an Excel spreadsheet, on page, and share with somebody, but this is problem 1-8A, which is on page 41 in the textbook. So what I want, Michelle, you have your book, right? I want you to read the transaction to me. What we're gonna do is we have to or basically put these transactions on this spreadsheet, and I'm gonna be doing it up here. We're gonna talk through it. But I'll read the first transaction. Lita Lopez invests $70,000 cash and office equipment valued at $10,000 in the company. Yes, it is customary for sometimes owners to invest both cash and assets into a business. So it doesn't always have to be cash, but it is all capital, regardless of what they invest. We understand that, right? Okay, so if she invested $70,000 of cash and office equipment of $10,000, tell me where those numbers go on your chart.
What cash?
So cash increased by 70,000,
Increase.
and then equipment, office equipment is 10,000.
80,000 increase in capital.
Good. Capital is 80,000. Okay, Michelle, read transaction B for me loud and clear.
Okay, the company purchased a $150,000 building to use as an office. Biz Consulting paid $20,000 in cash and signed a note payable promising to pay the $130,000 balance over the next 10 years.
So it's a lot of things going on there, right? What's the first thing that we can identify? They purchased a $150,000 building, so automatically, what increases and what decreases? Well, what increases? Tell me that.
Building increase.
Building for how much?
150,000.
What's your name, sir?
Pardon,
Barry?
Marion.
Marion. Mr. Marion is not the only one in here. So I want some other people to answer as well. Yes, ma'am. So what else happened in that transaction? So we increased our building by 150,000. That better?
Yes.
Okay, we increased our building by 150,000, and what else?
Paid $20,000 in cash.
They paid
20,000.
20,000 in cash. So what do we do with cash? Decrease. So we always reflect the negative, and you can put it in parentheses, so you know to subtract it. What else happened?
They owe over 10 years.
So the rest of the money they put on the notes payable, right? So what do I do?
Notes payable.
Positive 130,000 for notes payable, because it increased. Yes, ma'am.
The negative is just the parentheses.
Parentheses, Transaction C, what's your name? Rhonda, can you read transaction C for me loud and clear?
Company purchased office equipment for $15,000.
So the company purchased office equipment for $15,000 cash. What increases and what decreases?
Cash
Office equipment increased 15,000.
Equipment increases 15,000. What else happens?
Cash minus. And cash decreased 15,000.
Cash decreases 15,000. Yes, sir. One is due within 30 days, and the other one is extended beyond 12 months.
And that's the note payable that's extended.
Yes.
So accounts payable guys in 30 days.
It don't have to be 30 days, but it at least has to be paid within 12 months. So it's short term. One is short term, one is long term.
That's called net notes.
Up there, notes payable. Accounts payable is a temporary payable, meaning it must be paid within 12 months, short term. Anything that it extends beyond 12 months is considered to be notes payable, or it could be called something else, loan payable, mortgage payable, those types of things. Somebody read transaction D for me loud and clear, please.
The company purchased $1,200 of office supplies and $1,700 of office equipment on credit.
So they purchased $1,200 of office supplies and $1,700 of office equipment on credit. So what increases here? Office supplies increases for how much?
$1,200.
And what else increases? For how much? And what else increases? Accounts payable for how much? How much? $2,900.
How does that include
They put everything on credit,
I'm sorry.
so you add the two together. Somebody read transaction E for me, loud and clear.
Company paid a local newspaper $500 cash for an announcement of the offices.
So they have paid a local newspaper $500 cash for printing an announcement. So what happens? Cash decreases by,
500.
okay. And what else? Expenses increase by 500. All right, transaction F. The company completed a financial plan for a client and billed that client $2,800 for the service. So what's happening here? Accounts receivable for how much? And then what else? What else increases? What did you earn? Revenue for $2,800. Letter G, the company designed a financial plan for another client and immediately collected a $4,000 cash fee.
$4,000.
Cash increases $4,000 and revenue increases $4,000. Transaction H, Lita Lopez withdrew $3,275 cash from the company for personal use.
Lopez.
Lopez withdrawal.
How much?
$3,275.
Okay, and what else happened? And I'm sorry, I shouldn't have put this in negative, it is positive. Because her withdrawal account has increased. And this should be negative.
So it shouldn't be neutral.
Not under withdrawals, under cash it should be. Under withdrawals it should be positive. Transaction I, the company received $1,800 cash as partial payment from the client described in transaction F. So remember back in transaction F, they put $2,800 on credit, right? So now $1,800 is being paid towards that. So what increases?
Cash.
For $1,800, what decreases? For $1,800. Good job. And then J, the company made a partial payment of $700 cash on the equipment purchased back in transaction D. So transaction D is when they purchased that office supplies and equipment on credit. Now they're making a partial payment of $700 towards that. So what increases, what decreases? Or what decreases and what decreases?
Cash increases.
Cash decreases by $700, and what else?
Accounts payable decreased by $700.
Accounts payable decreases by $700. Good. And lastly, K. The company paid $1,800 cash for the office secretary's wages for this period. So what increases and what decreases?
Cash decrease.
Cash decreases by $1,800. And what else? Expenses. Expenses increased by $1,800 because wages are an expense. So now what's the best thing to do? Now we got to add everything up, right? So I'm gonna just use auto sum. And you verify that's what you have. Use your calculator to get that. And I'll pull it up in a minute so we can verify the total. Okay, are you guys coming up with the same amount? You don't know? Alright, so let me do this. Alright, so this is what you should get for each balance. Cash account, 34,525. Accounts receivable, 1,000. Office supplies, 1,200. Office equipment, 26,700. Building, 150,000. Accounts payable, 2,200. Notes payable, 130,000. Capital, 80,000. Withdrawals, 3,275. Revenues, 6,800. And expenses, 2,300. Now my question to you is, and I want you to give me the answer, what do you think net income is? Is everybody sure on that one? What do we use to get net income? What is it? Revenues minus what? Minus expenses. So what are the amounts? Revenues equal 6,800 minus expenses of what? 2,300 equal what? 4,500. Everybody agrees? So it's not, no, it's not profit. It's just showing what the company brought in and what they paid out, not necessarily whether or not they're profitable. Well, no, what it shows in expenses is what you owe, what you have to pay. But for that particular period, it's showing what kind of income you brought in. Now, that income could go to pay dividends or it could go to pay a lot of different things. Okay. So any questions about that exercise?
Scroll up to the top.